Welcome back, everyone, to the Deep Dive. Great to have you with us. Today, we're diving into something that's, well, it's really making waves, maybe quietly, in finance. What is stablecoin? Our goal today, and we're pulling a lot from the One More Money blog, is to really help you get your head around stablecoins. We want you to understand how they work, what they promise, and yeah, the risks too, before you even think about buying any. And hey, if you find this stuff interesting, crypto investments and all that, definitely hit subscribe on the One More Bitcoin channel. And check out the One More Money financial blog, too. We're always digging into new things there. Oh, and a quick like on the video. Always appreciate it. Let us know in the comments, too. Are stablecoins on your radar? Thinking of buying or maybe holding off? We genuinely want to know what you think. Okay, so let's set the scene a bit. Crypto. It's got this amazing, almost world-changing power, right?
Absolutely transformative potential.
But boy, does it come with some serious volatility, like financial whiplash sometimes. It's a wild ride.
It definitely is. And that's precisely where stablecoins come into the picture. Think of them as this really groundbreaking idea trying to bridge that gap.
Yeah.
They aim to connect that blockchain innovation with a much-needed dose of financial predictability. And as we found digging through the One More Money blog, really understanding these is, well, it's paramount for anyone investing in crypto today. It's just crucial.
Yeah, definitely. What exactly is a stablecoin at its heart?
Well, essentially, they're a specific class of cryptocurrency.
Okay.
And they're engineered, really specifically, to counteract those huge price swings you see with things like Bitcoin or Ethereum. You know, the crazy ups and downs.
Right, like finding a calm harbor in a pretty stormy sea. That makes sense.
That's a good analogy.
Right.
Their whole unique value proposition is that stability. They achieve it by pegging their value, tying it to assets that are way more predictable.
Like the US dollar. That's the main one, isn't it?
That's the most common, yeah. US dollar is dominant, but sometimes it could be linked to gold or other commodities. And it's this stable value that makes them such potentially useful tools in the crypto world. The One More Money blog really highlights them as, potentially the best stablecoins for stability.
And why is that stability such a big deal?
Well, it lets you use all the cool stuff about blockchain, the speed, the transparency, without that constant fear of the price crashing overnight.
Okay. So you get the benefits without maybe quite so much of the anxiety, like a sports car with really good brakes.
Exactly. Good way to put it. And that stability unlocks so many real-world uses. Think about sending money across borders super fast, or just, everyday digital payments, or even just holding value securely when the rest of the market is going nuts.
Right. So for traders, it's like a safe place to park their cash during a downturn.
Precisely. A safe haven. And for people new to crypto, or even big institutions, stablecoins can feel like a much more reliable way in. They offer that bridge built on, well, trust and predictability. Our reading of the One More Money blog suggests they're seen as a really vital step towards crypto becoming mainstream, bridging that gap between old school finance and this new decentralized world. So they aim for stability, but it's not like there's just one kind of stablecoin, right? They don't all work the same way. Not at all. The landscape is quite diverse. You can basically break them down into three main types. And each type uses a different mechanism to try and keep that value stable, that peg, each with its own, pros and cons. Let's start with the big one, the most common type, fiat-backed. How do these work? This is probably the easiest to grasp. The core idea is simple. For every single stablecoin token they issue, the company behind it holds an equivalent amount, or sometimes even more, of traditional currency in reserve.
So like US dollars, euros, pounds, sitting in a bank account somewhere.
Exactly. Or very often, it's not just cash. It might be things that are easily converted to cash, like short-term government bonds, U.S. treasuries that are really common, sometimes even high-quality, short-term corporate debt, what they call commercial paper. The main goal is always that one-to-one redeemability.
Meaning I can always swap my, say, one digital dollar crane back for one actual dollar.
That's the promise, yes. One-to-one backing.
And the big names here, people probably know Tether, USDT, that's the giant.
It is. Huge market leader, really provides a lot of the trading liquidity in the crypto markets.
And then there's USDC, USD coin from Circle, that's number 2, right?
Correct. Second largest. And they've really made a name for themselves by focusing on transparency, trying to be very open about their reserves.
Okay, but because a company issues these and holds the money, that makes them centralized, doesn't it?
It does. You have a central issuer like Tether or Circle, and that introduces what we call counterparty risk. You're trusting that company.
Right. And it means they fall under regulations.
Absolutely. And transparency, as you mentioned with USDC, has been a big, big topic.
Yeah, I remember Tether faced a lot of questions historically about what exactly was in their reserves. It wasn't always just cash, right? There was talk of corporate bonds, gold, even Bitcoin at one point.
That's right. And that complexity led to some concerns about whether they could always meet redemptions, liquidity worries.
But USDC took a different path.
They did. Circle focused on holding reserves mainly in actual U.S. dollars, kept in separate accounts at regulated U.S. banks, plus those short-term U.S. government bonds. And crucially, they provide regular monthly reports attested by independent accounting firms. So why the One More Money blog kind of jokingly called USDC Wall Street's good boy, they're playing by the traditional rules more.
Trying to be transparent.
Exactly. And this lines up with where regulation seems to be heading. Like that proposed Clarity for Payment Stablecoins Act in the U.S. It emphasizes reserves being actual dollar cash or very liquid U.S. treasuries.
Makes sense. And these companies, they're not just doing this for fun, right? They make money somehow.
Oh, definitely. They earn interest on those huge piles of reserve assets they're holding.
Okay, so if they're holding billions in treasuries, they get the interest from those bonds.
Precisely. The One More Money blog mentioned Tether reporting billions in profits. It's a very profitable model when interest rates are up. Crypto-backed stablecoins. Decentralization in focus.
Okay, so fiat-backed is centralized. What if you want that stability, but you're more into the decentralized ethos of crypto?
Well, that's where crypto-backed stablecoins come in. Instead of dollars in a bank, they use other cryptocurrencies as collateral.
Like using Ether to back a stablecoin.
Exactly. And the whole system issuing the coins, managing the collateral, it's typically run by smart contracts on the blockchain. The goal is decentralization.
But wait, if the collateral itself, like Ether, is volatile, how does that work? How do you keep the stablecoin stable?
Great question. That's the key challenge. They solve it using something called over-collateralization.
Over-collateralization. Sounds complex.
It just means you have to lock up more value in crypto collateral than the value of the stablecoins you want to create. So, for example, you might need to deposit, say, $150 worth of Ether to be allowed to mint $100 worth of the stablecoin.
Oh, okay. So that extra $50 acts like a buffer, a safety cushion, if the Ether price drops.
Exactly. That cushion absorbs the price fluctuations of the collateral, ensuring the stablecoin should remain fully backed, even if the collateral's value dips.
And the big example here is Day, right, from MakerDAO?
Day is the biggest and best-known crypto-backed stablecoin, yes. Although, it's interesting, Day has actually evolved. While it started purely crypto-backed, aiming for decentralization, it's become more of a hybrid. To improve stability, they now also include some centralized assets in their reserves, like USDC and even U.S. Treasuries.
Huh, interesting. So even the decentralized ones sometimes bring in centralized elements for stability.
Sometimes, yes. But then you also have projects like LUSD, Liquidity USD, which really try to stick to the pure decentralized ideal, backed only by Ether.
There's the third type, algorithmic stablecoins. And these ones...
Well, they sound kind of scary based on what I've read.
Yeah. Risky Frontier is a pretty accurate description. These are fundamentally different. They don't rely on holding direct collateral, like dollars or Ether.
No collateral. So what keeps the price stable? Magic.
Huh. Not quite magic, but complex algorithms and economic incentives. Often they use two-linked tokens. The system tries to automatically adjust the supply of the stablecoin based on demand, using algorithms and encouraging traders to buy or sell to push the price back towards its peg, usually $1.
Does that actually work? Well, that's the billion-dollar question, isn't it? Historically, these have faced massive problems. Sustainability issues and death spirals are terms you hear a lot, because their stability ultimately depends entirely on people believing the algorithm will work and continuing to participate. If confidence breaks,
It all falls apart.
it can, and catastrophically. The One More Money blog prominently features the most infamous example, Terra USD or USD.
Oh yeah, Terra Luna. May 2022, that was brutal.
Absolutely devastating. Wiped out tens of billions of dollars in market value almost overnight. A classic death spiral. And it wasn't the only one. Basis Cash, Empty Set Dollar, Titan. There's a history of failures here.
Okay, so those are the main three. Anything else worth mentioning quickly?
Just briefly, for completeness, you also have commodity-backed stablecoins.
Like backed by gold.
Exactly. Paxos Gold, PXU, and Tether Gold, XAUT, are examples. Each token represents ownership of a certain amount of physical gold held in a vault.
Here's where it gets really interesting, as they say. Just like blockchains have that trade-off between security, decentralization, and speed, stablecoins have their own version, right?
They absolutely do. It's often called the Stablecoin Trilemma. It highlights the fundamental challenge of trying to simultaneously achieve three desirable properties. Stability, keeping that peg rock solid.
Yeah.
Decentralization, operating without a single point of control or failure. And capital efficiency, using collateral effectively, not needing huge amounts locked up.
And the point is, you can't easily have all three. You usually have to compromise on one.
That's generally the case, yes.
Right.
Stablecoin designs tend to prioritize two aspects at the expense of the third. Think about it. Fiat-backed coins like USDC or USDT, they nail stability and they're very capital efficient. $1 backs one coin. But they sacrifice decentralization. They're completely centralized.
Right. And the crypto-backed ones, like maybe Day in its pure form.
Yeah. They aim for decentralization and stability, but they often struggle with capital efficiency because of that over-collateralization requirement. Logging up $150 to get $100 isn't very efficient.
And the algorithmic ones? They tried for decentralization and capital efficiency, no collateral, but completely failed on stability.
Precisely. As the One More Money blog points out, finding that perfect stablecoin design that masters all three parts of the trilemma, well, it's still something of a holy grail. It remains elusive.
Okay, despite the trilemma and the risks, especially with algorithmic ones, stablecoins are obviously booming. So what makes them so useful? What are the big advantages?
Well, number one has to be convenience and speed, especially for moving money globally.
Yeah, the One Money blog had some striking comparisons here. Sending money internationally through bank.
It's slow, can take days using the old SWIFT system, and its expensive fees can easily be over 5%.
Whereas stablecoins
can be transferred pretty much anywhere in the world in seconds or minutes at most. And blockchain fees are usually tiny compared to bank fees. Plus, you skip all the hassle with exchange rates.
That's a huge deal. What else?
There's the element of pseudonymity. Transactions are on the public blockchain, sure, but your real-world identity isn't directly tied to your wallet address unless you link it, say, through an exchange doing KYC/ML checks.
KYC/ML being know your customer and anti-money laundering.
Right. So for many traders, that mix of stability and relative privacy makes stablecoins, as the One More Money blog called it, an ideal trading currency.
And then, obviously, the core advantage, stability itself. For actual payments, for contracts, having a stable digital asset is key.
Absolutely. And finally, they're incredibly efficient within the blockchain world. You can't easily use regular dollars in decentralized finance apps or smart contracts. Stablecoins are the bridge, the lubricant that makes the whole DeFi ecosystem work smoothly.
And the growth numbers are just staggering. The One More Money blog cited the total market cap over $250 billion now.
Yeah, it's exploded. That's more than a 20-fold increase in just about 5 years. Incredible growth.
And the transaction volume, this blew my mind, $27.6 trillion in 2024.
It's almost hard to comprehend. But yeah, that volume actually surpassed the combined payment volume of giants like Visa and MasterCard.
Wow, so this isn't just some niche crypto thing anymore. It's handling serious global money movement.
It really is. It signals a massive potential shift in how payments might work in the future. And you see this reflected in the use cases. Cross-border payments, as we mentioned, are booming. We're talking about reaching something like $50 billion per month in stablecoin cross-border flows, growing at maybe 20–30% per month. It's tapping into this enormous, like $200 trillion annual market for international payments.
No wonder big companies are paying attention.
Exactly. Even traditional players are reportedly exploring it.
Another big one mentioned in the One More Money blog was their use in countries with high inflation.
Yeah, this is really significant. In places like Argentina, Nigeria, Turkey, Brazil, where the local currency is rapidly losing value.
People are using USD stablecoins just to survive financially, like a digital dollar.
Precisely. For everyday savings, for payments as a way to preserve purchasing power, it's become a vital tool for many.
And governments are starting to accept it. I thought they might resist.
There was resistance, but public demand is powerful. Brazil, for instance, actually integrated stablecoin capabilities into PIX, their official instant payment system. That's huge.
Wow.
Then there's the whole area of RWA real-world asset tokenization. Stablecoins themselves are arguably the first major example. But now you see things like BlackRock, the world's biggest asset manager, launching a tokenized version of US dollar money market fund, BUIDL, directly on the Ethereum blockchain.
BUIDL, like build but crypto spelling.
Right. And it attracted almost $3 billion in assets very quickly. That's a massive signal of traditional finance seriously engaging with blockchain using stablecoins as the rails.
We're also seeing payment giants jump in. PayPal has its own stablecoin now, PYUSD.
Yep. And Stripe supports payouts in stablecoins. Even crypto wallets like OKX Wallet have features like OKXPA for instant QR code transfers using stablecoins, just like you'd use Venmo or Apple Pay.
Okay, but we have to address the elephant in the room, too. The One More Money blog mentioned illicit activities.
Yes, it's important to be balanced. The very things that make stablecoins useful, the speed, the global reach, the relative anonymity, unfortunately, can also make them attractive for things like money laundering or terrorist financing.
And that's a major reason why regulators are getting so involved, right?
Absolutely. It's a huge driver for the push towards regulation and oversight globally.
Okay, let's talk regulation, because it feels like governments everywhere suddenly woke up to stablecoins. The One More Money blog highlighted this surge in legislation.
Definitely. We're seeing stablecoin-specific laws and regulations popping up all over the U.S., the EU, Singapore, the UK, Hong Kong. It's a global trend.
And what are they generally focusing on?
A few common themes emerge. Things like requiring issuers to get licenses, mandating that they hold 100% reserves in high-quality liquid assets, cash, or short-term government debt usually. Plus, rules around risk management, disclosures to users, and importantly, those AML-CTF, anti-money laundering, counter-terrorist financing controls we just talked about.
And the U.S. approach, that proposed Clarity for Payment Stablecoins Act.
Yeah, the idea there seems to be to create a formal federal framework. It would essentially allow regulated banks and potentially other approved institutions to issue stablecoins, provided they are fully backed by U.S. dollar cash or short-term treasuries. The strategic goal appears quite clear. Make regulated U.S. dollar-backed stablecoins a fundamental part of the global financial plumbing.
Which brings us to this fascinating point from the One More Money blog about the U.S. seeing stablecoins as a way to, quote, reconstruct the infrastructure of monetary influence. That sounds significant.
It's incredibly significant. It's about geopolitics and the future of the dollar. Think about it. Right now, something like 99% of the stablecoin market is pegged to the U.S. dollar.
Even though they could be pegged to the euro or yen or whatever.
Exactly. By encouraging and regulating USD stablecoins, the U.S. isn't just passively letting this happen, it's actively shaping it. This widespread use could lead to what's called de facto dollarization in other countries, people using digital dollars even if their government doesn't want them to. It expands the dollar's reach and influence globally.
So it reinforces the dollar's dominance in the digital age.
That seems to be the explicit goal. U.S. Treasury Secretary Janet Yellen has basically said as much. They want to maintain the dominant position of the U.S. dollar. And there's another angle, reserve holdings. If stablecoin issuers have to hold billions, potentially trillions, in U.S. treasuries.
That creates huge demand for U.S. government debt.
Precisely. The One More Money blog noted Tether was already a top 20 buyer of U.S. treasuries in 2024. J.P. Morgan even projected stablecoin demand for short-term treasuries could top $1 trillion by 2028.
Wow. So the strategy is don't fight it, shape it, embrace it, preemptively legislate and regulate to keep the dollar on top.
That appears to be the core strategy, yes. Don't let crypto undermine the dollar's global reserve status. Use crypto, specifically stablecoins, to reinforce it.
And looking globally, the One More Money blog painted a picture of different national strategies, right? Not everyone is doing the same thing.
Not at all. It's a real spectrum. You've got places like Singapore, Hong Kong, the UAE. They're being quite proactive, very open. Hong Kong is even pushing for stablecoins pegged to the Hong Kong dollar and the offshore Chinese yuan. They see it as an opportunity.
Okay, the open approach. What else?
Then you have what the blog called cautious but inclusive. That's probably where the U.S. and the EU fit best. The EU's MiCA regulation is groundbreaking, the first major framework, but it's also quite strict in some ways, like banning interest payments on stablecoin deposits and setting transaction limits. South Korea seems to be moving cautiously in this direction, too.
And the other end of the spectrum.
Strictly restrictive. Mainland China has banned crypto and stablecoins outright, focusing entirely on its own central bank digital currency, the ECNY. Places like Bangladesh, Afghanistan also maintain bans.
It's fascinating how different the approaches are.
It is. And you even see that if you can't beat them, join them. Idea playing out with traditional banks now. J.P. Morgan, whose CEO famously slammed Bitcoin, now has its own JPM coin for internal wholesale payments. That's a major shift. And fundamentally, stablecoins, especially when used in DeFi, challenge the traditional financial system through disintermediation.
Meaning cutting out the middleman. Like banks.
Essentially, yes. They enable more peer-to-peer financial services, bypassing the need for traditional intermediaries for things like lending, borrowing, and payments.
Must worry the banks and central banks too, right? The One More Money blog mentioned concerns about monetary policy.
Exactly. If a lot of economic activity starts happening using stablecoins outside the regulated banking system, central banks worry it could weaken their ability to steer the economy using tools like interest rates.
So they lose some control.
Potentially, yes.
Yeah.
Which is partly why you see regulators trying hard to define these things narrowly as payment stablecoins. They want to encourage their use for payments, but maybe discourage them from becoming widespread alternatives for savings or investments, which would have bigger monetary policy implications.
Okay, we've talked a lot about the potential and the growth, but we absolutely have to come back to the risks. The One More Money blog had a stark warning. Stablecoins are not absolutely safe. It's only relatively stable. That feels really important.
It's probably the single most important takeaway for any potential user or investor. Stable does not mean risk-free. Not even close.
So what are the specific risks we need to understand?
Well, first and foremost is collateral risk and transparency, especially with fiat-backed ones. We talked about Tether's historical opacity. Were the reserves always fully there? Were they liquid enough? If everyone tried to redeem it once, a bank-run scenario, could they actually pay out? That lack of transparency creates risk.
And even if the reserves are there, what if they're not in easily sellable assets?
Exactly. The quality and liquidity of reserve assets are crucial. If they hold risky or hard-to-sell stuff, it could lead to the coin losing its peg, depegging, or even collapsing if there's a crisis of confidence.
And even with crypto-backed coins, if they start using centralized assets like USDC in their reserve,
You reintroduce some centralization risk, yes.
then there are the algorithmic flaws. We saw what happened with Taro Des. That model just proved inherently unstable under pressure.
Absolutely. That's a fundamental design risk in many algorithmic models.
What about just things going wrong? Regulation changing? Hacks?
All major risks. Regulatory uncertainty is huge. The rules are new, different everywhere, and still changing. That creates uncertainty for issuers and users. Then there are operational risks, the platform getting hacked, funds being embezzled, simple mismanagement by the issuer. These can lead to loss of funds or depegging events.
And depegging has happened, even to the big ones, right?
It has, briefly. USDT wobbled a bit during the Terra Luna chaos, and USDC actually lost its peg temporarily in March 2023 when Silicon Valley Bank collapsed because Circle held some of its cash reserves there.
Wow, okay, so even the safest ones aren't immune to market shocks.
Exactly. It's a stark reminder the peg isn't guaranteed. Then, as we touched on, there's the risk associated with illicit activities, which attracts regulatory heat, and the fact that even stablecoins exist within the wider speculative crypto market.
One more thing the blog mentioned, interest conflicts.
Yes. Issuers make money from the interest on reserves. If general interest rates fall, they might be tempted to seek higher yields by investing those reserves in riskier assets to maintain their profits. That could compromise the safety of the reserves backing the coin.
Okay, that's a lot to consider. So for someone listening, thinking about maybe using or investing in stablecoins, what's the key advice from the One More Money blog?
The main message was crystal clear. Avoid blindly following trends. Don't just jump in because everyone else is.
Do your homework, basically.
Absolutely. Enhance your financial literacy. Really understand how a specific stablecoin works. What's its collateral mechanism? Who is the issuer? What's their track record? What's the technical setup? What's its regulatory status in your jurisdiction? You need to monitor policy changes. Is it approved by regulators? Are there regular independent audits confirming the reserves? These things matter immensely.
Yeah, that final thought from the blog really sticks. In the absence of sufficient, verified information, caution is not just asset protection, but also a necessary choice for ensuring personal financial security. Makes perfect sense. The One More Money blog seemed pretty bullish, projecting stablecoins becoming a foundational global payment method within, 5 to 20 years, reaching trillion-dollar scales.
Yes, the outlook presented is one of massive growth and integration. The idea is they'll move from being primarily a crypto trading tool to being a core part of everyday global commerce and finance. And this expansion, as we discussed, is expected to really reshape currency dynamics. The prediction is that USD stablecoins, given their head start in U.S. regulatory backing, will likely further strengthen the dollar's dominance, potentially becoming the global payment standard in the digital sphere over the next couple of decades. This could automate and streamline global transactions in ways we haven't seen before.
So what does this all mean when you boil it all down?
Well, the One More Money blog leaves us with a really thought-provoking idea. This isn't just about technology or finance. The rise of stablecoins is fundamentally about power projection and influence redistribution. It's a new arena for global competition in the monetary field. It prompts the question, in this emerging digital landscape, how will nations compete? It won't just be about resources or data anymore, but about achieving technological and institutional supremacy in the very design of money itself.
Wow. That is definitely something to chew on. A global competition for the future of money. Well, this has been absolutely fascinating. Thank you so much for joining us and walking us through this complex topic today. And to our listeners, thank you for tuning in to this deep dive on stablecoins. Now, for that important disclaimer, please remember everything we've discussed here today is purely for informational purposes. It is not financial advice. We've aimed to impartially report on the perspectives and information found in the One More Money blog, but we are not endorsing any specific views or investment strategies. Always, always do your own detailed research, consider your own circumstances, and ideally speak with a qualified financial advisor before making any investment decisions. Thank you again for watching. If you are interested in crypto investments, please do subscribe to the One More Bitcoin channel and also the One More Money financial blog. That way you won't miss our future deep dives. And please hit that like button if you found this useful and drop a comment below. Let us know after hearing all this, what are your thoughts on stablecoins? Will you buy them or are you staying clear? We really do read your comments. Thanks again, and we'll see you next time for another deep dive.